policymakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua, the ECB Forum on Central Banking here in Sintra, Portugal, and these are your top stories. President Trump says his July 9th global tariff deadline will not be extended as he ramps up criticism of Tokyo. Here in Sintra, the Fed chair says rates are on hold because of U.S. tariffs, but he doesn't rule out a cut in July.
We went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariff.
Plus, Trump's multi-trillion-dollar tax bill faces resistance in the House ahead of a vote later after narrowly passing the Senate. Now, President Trump's tariffs have been a major talking point here at the European Central Bank's annual conference. Trump has said he's sticking with his July 9th trade deal deadline while renewing his threat to cut off talks and slap duties on various nations, including Japan. Now, the world's most important central bankers discussed the impact when they took the stage during a panel I hosted yesterday here in Sintra. Now, the Fed chair, Jay Powell, repeated that the U.S. central bank probably would have cut rates further this year if it weren't for Trump's expanded use of tariffs.
In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time. As long as the U.S. economy is in solid shape, we think the prudent thing to do is to wait and learn more and see what those effects might be. And again, they haven't really shown up. So for now, we're waiting.
Now, also weighing on U.S. policymakers is President Trump's multi-trillion-dollar tax bill. Well, it's squeaked through the Senate on Vice President J.D. Vance's tie-breaking vote. But it's now running into Republican resistance in the House as moderate and ultra-conservative lawmakers threaten to defy the president and sink his domestic agenda. Now, as the bill continues to divide opinion, here in Sintra, the Fed chair also repeated a warning over Washington's debt path.
The U.S. federal, fiscal path is not a sustainable one. The level of the debt is sustainable, but the path is not, and we need to address that sooner or later. Sooner is better than later. That's what I said last year. There's not a lot more I can say.
Well, the Fed Chair Jay Powell speaking here at Sintra yesterday. Now we'll hear from some of the other leading central bankers who are on that panel a little bit later. Now, ECB Vice President Luis de Guindos told us yesterday that an advance in the euro beyond 120 could prove tricky for policymakers. He says current levels are not cause for concern.
The level is not the problem. I think that this is perfectly, acceptable according to our projections. Here the question is, that we should try to avoid any sort of overshooting. It's much more, the speed of the adjustment than the level. But I think that 117, even 120, is not something that we cannot. We can overlook a little bit. Something beyond that, it will be much more complicated. But 120, I think that is perfectly acceptable.
Certainly, the euro's fortune have been a hot topic of discussion here at Sintra, but also beyond the forum. Now let's head over to Anna Edwards, who's in London with a very special guest. Hi, Anna.
Good morning to you, Francine. Yes, absolutely. Back here in London, Stefan joins us, the CEO of the asset management firm DWS Group. Stefan, very nice to speak to you. Thank you for joining us here in London. As Francine was just setting out, the strength of the euro, quite a talking point at the ECB conference there in Portugal. And I wonder how that is factoring into investor conversations, client conversations that you're having. The strength of the euro at 117.76 against the dollar, not over 120, which Luis de Guindos said would worry him, but strengthening it seemingly all the time.
Well, I mean, certainly the speed this year has been strong, very fast. So, it strengthened 14 cents versus the dollar just year to date, and that's significant. I think the discussions are really twofold. To some extent, it obviously has an impact on company revenues, right? For the euro to strengthen, it makes European products more expensive across the globe. So that will have at some point impact on the underlying profitability of European companies. But at the same time, obviously, investors across the globe, they look at the strengthening of the euro And that comes on top of strengthening of the DAX, for example, of stocks, right? So therefore, it's really twofold to some extent. Underlying profitability is probably going to take a hit at some point, but at the same time, euro assets remain incredibly attractive.
Yes, and Francine was talking to Mario Centino earlier on, who was suggesting that the strength of the euro is perhaps driving more investment into Europe, attracting more investors into Europe as they worry about where the dollar's going to go. Do you see that? Is that what client conversations look like to you, Stefan?
So for sure, so just think about stocks in dollar terms, right? So the S&P 500 went up 5% for 6 months of the year. The DAX went up 20, and on top you have the 14 cents of euro appreciation. So if you're a US investor and you bought the DAX, you're up 35% in dollar terms year to date, and that's obviously significant. Now, what we have seen so far is that institutional investors are quite interested in European assets, right? So there's definitely a reallocation, probably away from the dollar, not overnight, but long-term over time, and towards Europe. For retail investors, US investors, they continue to just buy US stocks. So that's, I guess, what they know and what they like. But we've seen a significant repatriation of European retail money back from the US into European stocks.
OK, that's interesting. And does that make it a good time to look into stable coins that are perhaps pegged to the euro and not to the dollar? And I think you have some news about that this morning.
Well, we do. Thank you very much for bringing it up. So we actually just announced that our JV that we formed with Galaxy Digital and AllUnity, its name, that we formed with Galaxy Digital and Flow Traders, we got the BaFin license yesterday to issue the first euro stablecoin out of Germany. Right? And we feel that stablecoins, when you think about the many use cases that it has, today, but probably way more in the future, it's quite significant. Right?
Yeah. Does euro strength and dollar weakness, is that playing into the timing of this? Does that make it a good time to launch this kind of product?
I would have a more longer-term perspective, right? So you've had dollar stablecoins for some time, and Circle just IPO'd, and I guess that IPO shows that there's tremendous interest in stablecoins. But so far, we didn't have a digital euro, right? The ECB will probably, they're working on it, but that will take a few more years. So we definitely need to bridge into a digital euro, and we will, as AllUnity, will be the first properly regulated euro stablecoin out of Germany. So we feel that is significant.
Yeah, and what gap is that trying to fill, that kind of product? What's the gap that needs filling with this?
Important question, right? So what are the use cases? I mean, today, it's really mostly people moving from fiat to get their currency on-chain to then buy crypto, right? To some extent, you simply need to get your dollar, your euro, whatever, on-chain, then you can buy Bitcoin, whatever you want to do. I think over time, there's going to be way more use cases. So retail payments. So at some point, are we going to use wallet-to-wallet stablecoin payments in order to buy, pay for a cab or buy a beer at night? And I think once it actually goes to corporate payments, where again, like being able to do 24/7 fractional payments, I think it's going to be one of those use cases for the years to come.
Let me ask you about one theme that in Europe has been quite dominant so far this year, and certainly driven by a lot of the news flow out of Germany. And investment in the defence sector seems to become a real hot topic that a lot of investors want to talk to us about, and so CEOs are thinking about whether their businesses are offering those opportunities. So how is DWS thinking about the increase in defence spending we're going to see in Europe, and what role you play in that?
So firstly, this is going to be an irreversible trend. So the EU, or European countries, are clearly committing to spend a lot more on defense. So this train has left the station. This is going to come. So you'll have significant investments and a lot more of that going into European companies because of the idea that we should procure locally. Now, when you think about who can buy defense stocks, so far there was a self-imposed cap on not buying defense stocks for pretty much any fund. Now, what we're going to see going forward is that ESG funds will continue to not include defense. However, funds which are not ESG, they so far were restricted because of that self-imposed restriction. But going forward, they will invest in defense stocks.
And is that what DWS's funds will look like? So anything that's ESG labelled that won't have defence in there, but things that are not, there will be more investing in defence? Or has that started already?
It took some time because you sort of had to, without going into too much detail, but there was, this restriction that had to be lifted, prospectuses had to be changed. And then about a month ago, we gave green light to our PMs for the non-ESG funds to be able to invest in it. Now, I think one important question is, what about all of those non-publicly traded companies? So you see the big companies, the Rheinmetall and so on, but you have about 400 mid-cap companies that are essentially the defense supply chain. And obviously, as the number of orders for the big companies go up, all of the smaller non-publicly traded companies also need to increase capacity.
Yeah.
So when you think about impact for private credit, for example, there will be a lot of private credit for those non-publicly traded defense companies, and that's also something which DWS is very focused on.
Yes, what kind of role do you think DWS wants to play then in the private credit space to fund that medium size and smaller size business in the defense space?
So this is where our collaboration with Deutsche Bank really comes in. So Deutsche Bank, across its investment bank and corporate bank, they have access, they cater, they bank, they finance all of those companies. So therefore, that access is something which we would like to, through our partnership with Deutsche Bank, then make accessible and investable for our global investors.
What kind of businesses are we talking about here then, Stefan? What are the types of businesses that private credit might be the answer for?
I mean, arguably anyone who is not publicly traded and needs to materially either invest in any sort of disruption-led trend, or simply needs to increase capacity. And if you're not publicly traded, you don't have access to capital markets. You can just, you could IPO, but it's lengthy. It takes a lot of time. And for those companies to get growth capital from somebody like a Deutsche Bank, and then we are the ones essentially providing that funding through our global investor base, that's one of those things.
Are there still any questions about which types of companies can be funded? For example, those that make nuclear weapons. Are these still open questions for European investors, for people such as yourselves, or has this been settled? You talked about rewording in prospectuses, for example.
So there's clear definitions of what you would not fund, right? So there are a variety of, without going into too much detail, on all the horrible weapons that clearly you wouldn't want to be any part of. However, overall defense is something which is critical for sovereigns, for countries, and therefore kind of like the big, let's say, typically defense companies, that is definitely going to be in focus.
Okay, Stefan, thank you very much. Thank you for joining us. Good to see you on the programme this morning. Stefan Hoops, the CEO of DWS Group. Francine, back to you in Sintra.
Yeah. So interesting, Anna. Thank you so much. Really interesting conversation with the DWS chief executive. Coming up, we'll have plenty more from Sintra. We'll be speaking to Isabelle Mateos Lago from BNP Paribas on her key takeaways from the central banker discussions here in Sintra. That's next, and this is Bloomberg. Well, the ECB's Sintra Forum underscored a shared preference for patience due to continued uncertainty, but also revealed a growing divergence in the path forward for 5 of the world's major central banks. Now, for most of them, additional interest rate cuts are probably coming this year as the impact of U.S. tariffs becomes clearer, while the Bank of Japan is moving in the opposite direction. Its timing, of course, also clouded by trade policy. Well, I asked them what impact tariffs were having.
We faced a massive amount of shocks, compounded shocks occasionally, and we are now through that disinflationary process that we have conducted over the last 2 years. And yes, we are facing a lot of uncertainty. Yes, we are facing the risk of fragmentation increasing. And yes, we are facing geopolitical developments that are worrying generally, but that also are causing two-side risk to inflation. So we have to continue to be extremely vigilant. We have to continue to be committed to delivering on our target. And I think we are at this point in time in a very good position to do that. So we are well equipped to navigate the tormented waters that we should anticipate.
What can central banks in your position do to shield economies from the impact of trade tariffs?
Actually, about the tariffs impact on inflation, our current inflation is well stabilized around 2%, and we believe tariff tends to be deflationary rather than inflationary for 3 reasons. One is Korea is not likely to use retaliatory tariff. Second, we import 22% of our import from China, and recently export price of China has been falling at 5% a year for several years, and we believe that it will continue to do so. And at this moment, our growth rate is 0.8%, which is well below our potential growth rate. So aggregate demand pressure is much lower. So our problem is not the inflation itself, but the gross impact of tariff.
It's probably, Jay was saying, I think it's a bit too soon, I think, really to see the price effects coming through from the trade and tariffs action. We've made a point of saying also that, I think as Christine was saying, that these are two-sided. They could go either way. Could be weaker demand. We could see some supply chain disruption. And the second thing, of course, is that some of these effects, if you take the oil price story, it's gone up, it's come down, all since our last meeting, effectively. So, we always reach for the lexicon at this point. We've added unpredictability to uncertainty.
What do you see as the fundamental changes in your economy that make inflation more persistent?
So let me say, to put it simply, as you say, headline inflation has been above 2% for almost 3 years, while what we call underlying inflation is still somewhat below 2%. That's the situation we are in. But if I could decompose it further, there's probably about 3 components to it. First, there's underlying inflation dictated by wage price dynamics, whereby increases in prices affect wages, which further affect prices, helped by resilient domestic demand. This component has been going up slowly, but as I said, it's still somewhat below 2%. Then there's going to be perhaps a second component, which will be the expected negative effects of possible tariffs on the economy and on prices. We think the first component and the second component will produce a slow increase in underlying inflation toward 2% by end 26 or 27.
Some of the world's leading central bankers speaking to us yesterday. Now, for more on all of this, we're joined by Isabelle Mateos, Lago, Chief Economist at BNP Paribas. Isabelle, thank you so much for joining us. Look, yesterday was, a very interesting panel because over an hour you kind of really understood the differences and the fact that it's just the world is much more uncertain than we thought. Do you see a real divergence in how central banks will play this?
Good morning, Francine, and thanks for having me. And you did a beautiful job, obviously, getting interesting answers out of these leading central bankers. So, yes, I think what struck me was, at most of them are on a very good path to delivering on their mandate, to reaching their targets. Obviously, the ECB is already has landed on 2%. The others are not quite where they want to be. But you would have thought there would be much more self-congratulatory in a way, and they were not. They expressed confidence that they were on the right track, but indeed the mood was more concerned about this kind of veil of uncertainty and downside risks mostly that all of them saw on the horizon.
So maybe let's take each central bank, one by one. If you look at the ECB yesterday, look, they touched that 2% inflation target. Mm-hmm. This was also helped by euro. At what point does euro actually become a problem for the European Central Bank?
The euro has been featuring in a lot of the conversations, including off panels. Honestly, I think one shouldn't have too much recency bias here. 120, and we're not even there, is not a particularly high level for the euro if you look at the entirety of its history. So, okay, it's appreciated meaningfully against the dollar since the start of the year, more or less 10%. But actually, most currencies in the world have appreciated against the dollar. And so, if you look at the real effective rate, actually hasn't moved that much. So, obviously, if we were to see much larger moves from here, at some point it will become a problem. But I don't think we're in that zone yet.
I mean, the Vice President yesterday, De Guindos, told us that actually 120 could be problematic. Was he overstating it? Is there a risk that the market tries to test it now?
There's always a risk that when you give the market a target that it tries to test it. But I don't think there's any particular magic value to 120. I mean, people like to set round targets. If you look at our published forecast for the year end, it is also 120, but there's nothing particularly magical about it, and I haven't seen or heard any particular research saying 120 is, if you go above that, it's a problem. In fact, I think the historical average, long-term historical average, is above 120. So I don't think it's an issue.
It's about what are you expecting for the ECB to do? One cut?
Yeah, we're expecting one cut. Obviously not in July, but by the end of the year. I think it's noteworthy, obviously, that despite inflation being back at 2%, President Lagarde explicitly said, "I'm not declaring mission accomplished." So I think there's a signal there. And when you look at the balance of risks over the next 3 to 6 months, I think they are clearly on the downside, and that's what you hear as well. Obviously, the ECB's own forecast has inflation in 2026 being well below 2%, being at 1.6, which probably means it's going to be lower than that even for a few months. And so the risks to activity, the risks from the exchange rate side, commodity prices side are really primarily on the downside. So I think one cut makes sense, but the timing of that we have to see.
Isabelle, I have to say, I thought Jay Powell, I mean, he doesn't have an easy job because of the personal attacks from President Trump, but also just the fact that the economy, you know, he was really much in a wait and see. Like, let's see if the inflation changes because of the tariffs, and otherwise they'll readjust. Like, what did you find him?
I thought he was incredibly delivering a message of a steady hand exactly where you need it, and extremely focused on, you know, giving a message that, you know, doesn't make him hostage to any kind of political interpretation. But also, and the contrast with Andrew Bailey there was quite interesting. Andrew Bailey had no problem in saying the direction of travel is clearly, you know, cuts. Jay Powell didn't say that. Jay Powell said, you know, there are many paths possible from here, and I'm not ruling anything in or out. Which was, of course, appropriate given the circumstances of the U.S. economy. But it was more than a nuance, I think, between these two central banks, which still have very elevated interest rates.
Isabelle, we heard actually from President Lagarde yesterday saying she would do the same as Jay Powell. Here she is.
I think I speak for myself, but I speak for all colleagues on the panel. I think we would do exactly the same thing as our colleague Jay Powell does. The same thing. Yeah. Right?
Yes.
I mean, there was a sense of like the central bankers actually rallying around Jay Powell, right? To I don't know whether it was to give him courage, but again, there's a lot of unknowns in the U.S. economy and a lot of shocks that kind of make sense for him to look at scenarios rather than maybe give guidance forward.
Yeah, that's right. I mean, so it's not just, I think, the central bankers rallying around Jay Powell. It's everybody who cares about central bank independence who feels for him every time there's an attack and admires his professional,ism and his steeliness in staying focused on doing the job, which I think is what we heard, and what the public needs from central banks really is not get caught up in politics, but deliver on their mandates. And I think they're all doing that very well. But obviously, Jay Powell faces the toughest circumstances.
Isabelle, do you see actually some of the inflation concerns materialize in data? Is it normal that it's taking this long?
It has surprised us that it's taken this long to show up in the data, but we have pretty strong conviction that it's going to start showing up through the summer months. It's not, if you think about it, it's not all that surprising given the continued uncertainty about what's going to be the final level of tariffs, that companies would be a little careful in changing prices. Also, we know they had accumulated a lot of inventory, so they're running through that inventory now, so they didn't really need to push up prices, preemptively. There's every reason to expect prices to show up in the coming months. But even then, even as they do, you will still have a debate between reasonable people, including on the FOMC, between those saying, well, don't worry, it will be a one-off effect and we can look through it, and others who will be more worried that it could be longer lasting. And I think the state of the labor market will be key in making the judgment whether it's okay to ease monetary policy a little bit, or indeed if it's necessary to ease monetary policy if really the labor market shows signs of excessive weakness, or whether, on the other hand, the second round effects is a real danger and monetary policy needs to stay restrictive.
Isabelle, thank you so much, as always, for joining us. That was Isabelle. Mateos, Lago, Chief Economist at BNP Paribas. We'll have to get you back on to talk about the Bank of Japan. There is a little bit of concern about the wind here in Sintra, but we're fine. We're in a veranda. It is sloshing around. It's not a hurricane. It feels like it, but we're fine. Coming up, Holger Schmieding, the Chief Economist of Berenberg, join us to talk about, he's talking to us about Euro area's economic outlook, but also trade uncertainty. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Sintra in Portugal at the ECB Forum on Central Banking. Now, these are your top stories. President Trump says his July 9th global tariff deadline will not be extended as he ramps up criticism of Tokyo. Here in Sintra, the Fed chair says rates are on hold because of U.S. tariffs, but he does not rule out a cut in July. Plus, Trump's multi-trillion-dollar tax bill faces resistance in the House ahead of a vote later after narrowly passing the Senate. Now, the European Central Bank is in no hurry to reduce interest rates further following 8 cuts in the space of a year. That's the view of the Governing Council member, Mario Centeno. Now, he also told me weak growth is a real concern.
Neutral means that everything else is also in equilibrium, if I may say. This is kind of too technical, but it means that we are at our potential in terms of growth, that the labor market is also in equilibrium. We are not there yet in terms of growth. So for the system, for everything to be in equilibrium, then the neutral for interest rates would be an important concept. And we have a history in Europe of very low inflation. Right. And I did see the fundamentals for that to be changed as much as we can comfortably only sit at neutral. But this doesn't mean that we need to rush into that. We need to see data. We need to look at what are the developments. The second quarter figure for GDP will be very important because if it confirms the first quarter number, that is a story. If we go again to tumble a bit in terms of growth, that will raise concerns, in my view, about how sustainable will the 2% inflation be.
Governor, should we worry about the inflation numbers going down significantly?
That is precisely my point.
But you're worried about them going down more than going up?
Yes. That's actually also the profile for inflation in our forecast. Yeah. We will begin 26 with a low number. There are base effects on that, but it's also the recent history of Europe. It's not one of high inflation, high pressure on that. So we need to be cautious about it.
Well, that was Mario Centeno, the governor of the Banco de Portugal. Now, euro area inflation rose in June to hit the European Central Bank's target. However, President Christine Lagarde stopped short of calling it mission accomplished.
We are at 2%. And this is the latest reading. This is also the target that we have had, and this is the projection that our staff is indicating for the medium term, which is exactly what we had anticipated. So I'm not saying mission accomplished, but I say target reached.
Well, Lagarde was, of course, speaking on a panel of central bank chiefs here in Sintra. Joining us now, Holger Schmieding, Chief Economist at Berenberg. Holger, good to speak to you. Is it mission accomplished for the ECB?
Well, it's not mission accomplished. It's, of course, for once we are at target, we'll probably be close to the target for the next roughly 12 months. But the ECB will face 2 tough challenges. First of all, how to react to the tariff tensions now, knowing that whatever the ECB does now to monetary policy will have its major effect, say, 12 to 15 months from now. Monetary policy works with a lag. And the second challenge is to figure out what's going to happen to the labor market. We know demographics. We know we will have labor shortages in the future. Does that mean that rates in the future actually have to be higher to combat wage pressures, which at the moment are low, but will likely pick up 1 or 2 years from now again? So that might be an argument for the ECB to say, if they're clever, don't cut rates too much now, otherwise we might have to hike them in 2027.
But Holger, so are you expecting a cut actually from the ECB this year? And how much of a worry is the euro level?
I don't really expect an ECB rate cut this year. I do assume that Trump and the tariff threats, that he will not follow through on the worst of it, that his bite will actually be less bad than the bark. We are now once again in the bark period, him putting pressure on everybody to get something done by 9 July. But if the tariff tensions subside a bit over the summer, then probably economic indicators will suggest that the Eurozone economy will start to recover late this year. And then actually, with an inflation outlook, we are at 2, will remain close to 2. I wouldn't see a reason for a cut.
Holger, when you look at euro level, so this has actually helped with inflation. We spoke to the vice president of the ECB yesterday, and he said, look, 120 is a danger. I mean, do you worry that actually if euro becomes too high, it starts becoming a real problem for central banks?
I think it's a modest problem. The currency moves that we've seen this year by historic comparison are not really very disruptive. The economic effect of what we see now, dollar euro, is probably in the range of 0.1 percentage points on Eurozone GDP. It's a bit on Eurozone inflation, but it's not really, in my view, a big game changer. The thing is, if of course we now go rapidly 120 and then above 120, the mere speed of the rise of the euro would then be a concern. But so far, this is an orderly adjustment to new circumstances. The US is less popular with investors for one reason, Trump.
When you look at the strategic review, is it easier actually to understand, they're moving to, or they're thinking about moving into scenario-based expectations. Is that easier to deal with Trump tariffs and to try and understand, I guess, the Venn diagram of the different decisions that could take place?
It doesn't really make the decision much easier, but it does inform the debate. It's good that the ECB now has more of an organized what-if debate, because in this world there are a lot of what-ifs. But it basically means that they think ahead of time what might happen if. It doesn't mean that the decision at the moment, when you don't quite know what's going to happen, is really informed by that or structured by that. I find it a nice exercise. Having said that, the result of the strategy review, in my view, doesn't give us much of a clue about what happens in the future, because it seems to codify the way in which the ECB debate has indeed moved over the last few years anyway.
It's tough being a Fed the Fed governor right now, the Fed chair right now, given all of the uncertainties on the economy. When do you think we start seeing a little bit of anxiousness actually, show up in the data?
Well, Fed Chair Powell here in Sintra said that he expects to see some inflation impact over the summer. And this is roughly in line with our view and the view of many others. Eventually, the huge inventory buildup that we had, the huge trying to beat the tariff surge in US imports, will be through. And hence, prices are likely to rise somewhat over the summer, which is actually one reason why I think that in the end, over the course of summer, Trump will prefer to strike deals rather than to explain to congressmen, to explain to the public, prices are higher. Why is that? Wasn't my tariffs, or was it?
But Holger, is it possible that the U.S. economy is just much more resilient than we thought?
That's a separate issue. The U.S. economy is resilient. We've said that for a long time. Don't bet on the U.S. consumer going down. Don't bet on anything like a U.S. recession. Trump would have to get much worse. Or more precisely, he would have to follow through on his worst tariff threats to really sink the U.S. economy. U.S. households, they have a job. They do have a significant wealth effect from equity markets, and they are used to some political noise. So for now, it looks like an orderly deceleration of US growth, but not anything worse than that.
But so if the companies are strong, is it possible that they absorb some of the inflation costs before passing them on? So that, again, the delay is much longer than we think.
That's, of course, possible. Still, with consumer demand not flagging, I'd be surprised if US companies take much of the damage from the tariffs for a long time. And would also be surprised if exporters from the rest of the world simply just took the hit. It would be very much against economic experience. Ultimately, the consumer pays.
Holger, I mean, look, I had a really, quite interesting and fun time moderating the panel. Is there anything that surprised you the most? I mean, the interplay between Bank of Japan, but also Bank of Korea, for me, was quite telling.
First of all, it was a well-moderated panel. Thanks a lot to you for that. Really,
I liked
it.
Compliment, but okay.
No, you weren't fishing, but you really, I thought, if I would have had a list of questions I would like to have posed, all of them were on it. Great, good. So, what I found most telling is, of course, Jay Powell. The way he clearly said we are on hold because of tariffs. The clarity of the statement surprised me, and also the clarity of many other statements. I found, okay, for central bankers speaking publicly, that's unusually clear. As to the Bank of Japan, of course, they don't quite know. Interesting interplay between them and the Koreans. But the basic message seems to be probably we will have to hike rates again in the foreseeable future. But we, of course, have to wait what now happens with Trump tariffs. And Japan-Trump tariffs are among the issues of the day today.
Yeah, it's true, Holger. There was a sense, actually, that they had a purpose, right? That they felt like this was an important moment in history where they had to play the role. Thank you so much. I'm blushing. No one makes me blush. Holger Schmieding, the chief economist at Berenberg. Now, coming up, the UK Prime Minister, Keir Starmer, abandoned his welfare reforms to avoid a crushing Commons defeat. But at what cost? We'll break down the implications of that next. And this is Bloomberg.
The level of household and corporate debt in the UK economy is actually lower than we would have expected it to be, but based on past experience. So again, that feeds through into just how restrictive policy is at a given interest rate. It's somewhat less restrictive probably than it would have been historically.
Andrew Bailey there, the Bank of England governor, speaking here in Sintra. Now to the UK now, where after market, UK Prime Minister Keir Starmer dramatically abandoned his flagship welfare reforms to avoid his first ever parliamentary defeat. But at what cost to his authority and the nation's finances? Well, our UK correspondent Lizzie Burden joins us now for more. So Lizzie, this was interesting. It was rather unexpected that he abandoned it. How weakened is the Prime Minister?
Oh, really weakened, Francine. I have to say he had an ugly choice before him. On the one hand, he could have accepted a humiliating defeat in the Commons. He should be able to pass his flagship legislation when he's got this huge historic majority. Or on the other hand, he could have made this embarrassing U-turn. But he went for the U-turn, which meant that he had to drop the most contentious part of the welfare bill. Some Labour MPs had called it Dickensian because it was all about restricting benefit payments to disabled people from next year. But as you suggest, the cost is both political and economic because it means he's given up all the savings that he would have got from the reform. That means it's even more likely we'll have tax rises or looser fiscal rules by the autumn. That means that the Chancellor's job's on the line, the Prime Minister's weaker, and all the while the government's still billions in the red.
Lizzie, there's also bad news for the Chancellor from the fiscal watchdog.
Yeah, the OBR admitting yesterday that actually it's more optimistic than the consensus of economists when it comes to its medium-term growth outlook. So bad news for Reeves because by the autumn, when she puts out her budget, it could be that the OBR downgrades its productivity and growth forecasts. That would mean she has less headroom. We know that her headroom already is a wafer-thin margin against her fiscal rules. So even more likely that she's going to have to raise taxes, which doesn't help with the growth picture. That means that the UK would be in a doom loop. And Francine, it really leaves very few options for Reeves and Keir Starmer when it comes to making up that growth shortfall. Do they need to make even closer ties with Brussels? Not going to be popular with all the Brexiteers.
Lizzie, thank you so much. Lizzie Burden there with a roundup of UK politics. Now, President Donald Trump says he's sticking with his July 9th trade deal deadline while renewing his threat to cut off talks and slap duties on various nations, including Japan.
You're writing letters to a lot of countries, and I think you're just starting to understand the process. We've dealt with Japan. I'm not sure if we're going to make a deal. I doubt it with Japan. They're very tough. And therefore, you'll pay a 30%, 35%, or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know.
Well, joining us now is our EMEA News Director, Roz Matheson. Roz, good morning. So do we have a response from Japan? Could there be a compromise on rice?
Well, it's very difficult to see where the compromise might be. As you were just noting, Japan is now the country very much in the crosshairs with Donald Trump on trade. We did have a response from the Prime Minister Shigeru Ishiba overnight, but in a way, what he was saying is just reminding the US that Japan is the biggest investor in the US, and there's a lot at stake here for the US as well. I mean, Japan's adopted a policy here in its negotiations of being firm but pretty friendly. The question is, does it sustain that? Does it take a harder approach? The idea from the Prime Minister seems to be that he would prefer no deal at all versus rushing to do a bad deal, because he has domestic factors here very much front of mind. There's an upper house election coming in Japan in the near future this month. Of course, he's got two key lobbies to think about: the auto sector and farmers, the agricultural sector. I mean, rice aside, in the car sector, that's almost 10% of Japan's GDP, 8% of the workforce. So a very important part of the Japanese economy to take care of. Rice, again, farmers are an incredibly important lobby group and voting bloc in Japan. And that's why for many, many decades, you've seen Japanese governments successively take a lot of careful care of the farming sector. And so very hard to see movement on rice, hard to see movement on cars. The question again is, like, is there anything that Japan can cede the floor on a bit here to get a deal?
So, Roz, I mean, if you look at Trump's tax on spending bill just passing through the Senate, it heads back to the House. Are there any more hurdles there?
Well, there are quite a few hurdles still to getting this done. I mean, this bill is squeaked all the way through so far. It got through the House in its initial state by one vote. It got through the Senate with the tie-breaking vote of the US Vice President, J.D. Vance. It's back in the House, but it's in a different form. And so the Republicans can only lose three members with this to pass if all the Democrats vote against it. And that's a very slim margin, because we're already hearing that Republicans are not happy with the version they're now presented with again in the House. And the challenge is you've got two different groups here. You've got moderates who are saying, hang on, you're cutting too much here in this bill, particularly again around things like Medicaid. You've got some Republicans saying you're not cutting enough, you're spending too much money, we've got to find more. So squaring that when you've got two very different groups here and making sure all those Republicans are willing to get over the line is very difficult. So that's going to be the challenging part, is they've only got 3 spots they can lose. We know at least 2 who are very much against this bill in its current form. So it's going to be a negotiating exercise. The question is, Donald Trump is really much the person who's pushing this himself. He's out on social media. He's saying to these Republicans, if you go against this, watch out. So again, there's a little bit of leverage potentially there from Donald Trump himself, just using his own influence to try and get this over the line, but it's going to be close.
Thank you so much, Roz Matheson. There, a terrific roundup, of course, of what we can expect in the next couple of days. Now, as Elon Musk moves to shore up Tesla, politics back at the fore, in particular, his relationship with the U.S. president. We all saw the tweets. Now, Trump has suggested that Doge, the cost-cutting effort Musk himself helped set up, could be unleashed on the subsidies for the billionaire's business. Well, we're now joined by Craig Trudell, Bloomberg's card czar. Craig, I have to say, I mean, it's like a telenovela. It unfolded in really ugly ways. Just when it appeared that Musk and Trump had entered a kind of détente, a new war of words. What's going on?
Yeah, I think there was a lot of reason to think that these two both had a lot to lose to continue to be at each other's throats. And yet here we were again yesterday with Musk, really, continuing, I think, a days-long sort of diatribe against the spending bill, and Trump really throwing some really firm brushback pitches and threatening the subsidies for his companies. Tesla in particular is really vulnerable here. There's only so much one would reckon that the U.S. can do to SpaceX when it's so reliant on that company for its launch business and for products like Starlink. Yet Tesla is in this position of, as we've known for months, being really in a tough spot when Trump has made it very clear that he is not a fan of Biden's policies to incentivize electric vehicle purchases, the writing was sort of on the wall there, and it seemed as though Musk was willing to sort of overlook that as he was really sort of emphatically behind the president. And yet, as push has come to shove, we've seen him really get critical of this budget, which would pretty significantly pull back on support for EV purchases and potentially hurt incentives as well for manufacturing of batteries, which I think a lot of people sort of overlook when they take stock of all the support that has been put in place to get the EV business going in the U.S.
Yeah, I mean, Craig, there's heightened scrutiny as Musk takes greater control of Tesla again to revive sales. Another top executive has left. So what does it mean for the company? Can he actually hold it together?
Yeah, it's interesting. So last week, Bloomberg broke the news that Omid Afshar, one of Musk's longtime deputies, had left the company. And this was a big change because he had a lot of responsibilities, a lot of reporting lines that now have to be divvied up. And one of the things that we reported just yesterday in a follow-up story is that Musk will take responsibility for sales in the U.S. and Europe. And there's some irony here, of course, in that, Musk, I think a lot of people have concerns about, just to what extent he is the problem here and a big factor in why this company is having so much, of an issue selling vehicles. We will get a better sense of just how much, this company is in trouble from that perspective later today when they report vehicle deliveries. The expectation is for another decline sort of in line with the 13% drop in the first quarter, and that would leave them in a pretty big hole to dig out of to avoid a second consecutive annual drop.
Craig, thank you so much. As always, Craig Trudell there, Bloomberg's global autos editor. We'll also have to talk about deportation threats, but we'll get onto that later. Now back to the ECB's annual conference here in Sintra. Most of the policymakers we've heard from share the view that additional rate cuts are probably ahead this year as the impact of U.S. tariffs become clear. Now, for more on the main key takeaways, we're joined by Alex Weber, our Euro area economy reporter. Alex, so good, so good to spend a bit of time together because we always like to tap you for insights on the ECB, but also to get your thoughts on what Christine Lagarde said yesterday. I mean, she didn't cry victory, but actually the ECB seems to be in a much better place than all the other central banks.
Yeah, there's definitely the sense that policymakers feel they're in a really comfortable spot. As if to underline that the euro area inflation reading came in exactly at 2% yesterday, so that was really helpful for the message Lagarde sent on the panel. It's supposed to come in a bit below that level in the coming months, but still policymakers feel like they've done the job. And now it's just monitoring the various shocks that are out there. So there's definitely a bit of paranoia even out there to see how things pan out on trade. Situation in the Middle East was a stark reminder that things can still go wrong.
Yeah. Alex, I mean, this is a loaded question, but how much is this thanks to the ECB, the fact that they cut 8 times and so now they're in a better place? And how much of it is actually luck of the draw, that, they had the euro on their side, that there's a number of things structurally that means that it's just a little bit more comfortable being in Europe right now, being the central banker to Europe than it is the rest of the world?
That is really a tough question. I mean, for the ECB, they're kind of running a victory lap now. They feel like it was down to the ECB to a large extent. Of course, they were helped to a large extent by energy costs. Just like energy costs punished them when inflation was rising. When it came down, it was also a lot due to that factor. On the other hand, the signaling from the ECB, the hawkishness, did also send a message to companies, to labor unions, that the ECB is on the job. So the wages are a big part of the story. It's really difficult to say. It probably would have unfolded very differently had the ECB just stayed on the sidelines.
What will be the main key takeaway that you take away from Sintra? I know a lot of the focus has, of course, been on Jay Powell and the fact that here he can speak to peers that understand the pressures he is going through, even if he gets attacked by President Trump on a daily basis. Yeah.
It's true that for the ECB, we didn't learn a whole lot of news on the rate path. It seems eminently clear there's going to be a hold in July, and then possibly, and there's some openness to cut further in the fall. The most interesting bit was perhaps the comments we got on the euro. Mm-hmm. So usually the ECB is very hesitant to comment on the exchange rate. They say they take it into account, of course, because it matters for inflation, but they don't want to be seen as targeting a certain level. This time was a bit different. There were really explicit comments on some showed really concern about what this means for the economy, could weigh down on the economy, could further depress prices. So this is something that could really tilt the balance in the fall toward further cuts if the exchange rate continues to develop as we've seen, if the euro keeps strengthening.
So interesting. Thank you so much, Alex Weber there, our Euro area economy reporter. Now, coming up from Sintra, we'll have plenty more interviews with Bank of England policymaker Alan Taylor and the governor of the Bank of Finland, Olli Rehn. So those interviews coming up in the next hour. Up next, a Bloomberg Brief, and this is Bloomberg.